Hi guys, for this video lesson, we're going to discuss different markets for stocks and bonds under your general mathematics from quarter 2, module 9. I'm your subject teacher, Arvin Enriquez. Our lesson objectives: at the end of this video lesson, you are expected to describe the different markets for stocks and bonds, solve problems involving stock valuation, solve for the face value and redemption value of bonds, and solve for the bond premium and discount on bonds. Let's go now with the different markets for stocks and bonds. Many of us deal with stocks and bonds or want to, but have no idea what are their worth. Maybe you want to try investing. You may want a better understanding of your investments. Or if you work for a big corporation, your employer may sell shares, and you need to determine whether it's worth the price. Either way, it is good to know the difference between stocks and bonds and have a basic understanding of how they are valued. So with this video lesson, we're going to discuss the different markets for stocks and bonds and the difference between your stocks and bonds and what is the value of stocks and bonds. I want you to take note of this, that the value of stocks and bonds is the fair market value per share. It is the fair market value per share or bond on the applicable valuation date. That's how we value your stocks and bonds. Again, when we say the value of the stocks and bonds is the fair market value per share. It is the fair market value per share or bond on the applicable valuation date. So before moving forward with our main concern, let us now recall some of the terms which are related to stocks. For your first term, and that will be your stocks, it is the share in the ownership of a company or a business. These are share in the ownership of a business or a company. So that's how we define your stocks. When we say dividend, it is the share in the company's profit. So that's how we define your dividend, no? When we say dividend per share, it is the ratio of the dividends to the number of shares. So we just simply divide the dividend by the number of shares, and it pertains or it represents the ratio between these two variables, and that will be your dividend per share now. Now, for the fourth term, that will be your stock market. So we define your stock market as a place where stocks can be bought or sold. The stock market in the Philippines is governed by the Philippine Stock Exchange or PSE. So you need to take note of that the stock market in the Philippines is governed by the Philippine Stock Exchange or the PSE. Or we can say that this stock market is a place where shares of public listed companies are traded. So the primary market is where the companies float shares to the general public in an initial offering, or we can say that is your IPO, the initial public offering, to raise capital. That's why we can buy and sell a stocks because it is the share in the ownership of the company. So we can uh, sell stocks because we want to raise capital. We want to extend our existing company or to build a new businesses. So that's how we define your stock market. Now, moving forward with the next term, which is your market value. This is the current price of a stock at which it can be sold. Or we can say that this market value is the amount for which something, no, can be sold on a given market. Meaning to say, when we say market value, it is the current price wherein it can be sold. Now, for this next term, which is your stock yield ratio, it is the ratio of the annual dividend per share and the market value per share, also called the current stock yield. No, with this one, when we say dividend yield ratio, no, it shows what percentage of the market price of a share a company annually pays to its stockholders in the form of dividends. So that is your stock yield ratio. So it is calculated by dividing the annual dividend per share by market value per share. So that's how we get the value of your stock yield ratio. And for the last term here, no, as you can see, that will be your FAR value. So the FAR value now is the per share amount as stated on the company certificate. So it was being stated on the company certificate. So unlike market value, it is determined by the company and remains stable over time. Now, in a simple word, no, your FAR value now is the value of a single common share as set by a corporation's charter. So it's not typically related to the actual value of the shares, but in fact, no, it is often lower. Any stock certificate issued for shares purchased shows the par value. That's why we define your par value as a per share amount as stated on the company certificate. So when authorizing shares, a company can choose to assign a par value or not. So it can be assigned or not. It depends on the company perception. Now, moving to your stock valuation. Your stock valuation are considered to have high value if the stockholder gets higher dividend at present and in the future. Otherwise, the stock is considered to have a low value. The computation of stock value is necessary in order to know if the stock market value is cheap or expensive at a given time. So dealing with this stock valuation, so for me, your stock valuation is an important tool that can help you make informed decisions about trading. So we can actually use the concept of your stock valuation in trading. So it is a technique, no, that determines the value of the company's stock. Yes, we use the stock valuation to determine the value of a company's stock by using standard formulas. So there is a formula designed for this stock valuation for us to know and for us to determine the value of the company's stock. So it values the fair market value of a financial instrument at a particular time. So that's how we deal with your stock valuation. Now, dealing with your example number one here, so a certain financial institution declared a 30 million pesos dividend for the common stocks. If there are total of 700,000 shares of common stocks, how much is the dividend per share? So first thing to do is to list down all the given values, and that will be your 30 million pesos as the total dividend and 700,000 as the total shares. Now, our main goal now is to find the value of the dividend per share. Now, for the solution, we just simply divide the total dividend per share, which is 30 million pesos, as your numerator here, and by the total share is 700,000 as your denominator here. As you can see, if we divide your 30 million by 700,000, the resulting value is 42.86 pesos. So that will be 42 pesos and 86 centavos. So therefore, the dividend per share now, upon simplifying this fraction no, between the total dividend and the total shares, the final answer is 42 pesos and 86 centavos. And that will be the final answer for the value of the dividend per share in this example number 1. So for example number 2, a certain corporation declared a 3% dividend on a stock with a par value of 500 pesos. Mrs. Lingan owns 200 shares of stocks with a par value of 500 pesos. How much is the dividend she received? So our main goal now is to find the value of the dividend that Mrs. Lingan received. So first thing to do is to list down all the given values. So the given values is the dividend percentage, which is 3%. The par value is 500 pesos. The number of shares is 200. And now we're asked to find the dividend. For the solution, so the dividend per share is 500 pesos. So we simply multiply 500 pesos by the dividend percentage. So we multiply your par value. As you can see, your par value here will be multiplied by the dividend percentage. So we convert this 3% no, to decimal by simply dividing this 3% by 100 to make it 0.03. And after simplifying or converting this 3% to decimal, we multiply it to your par value, which is 500 pesos. And if we multiply 500 pesos by 0.03 or 3%, so that will be equal to 15 pesos. Meaning to say that the dividend per share now is 15 pesos. Now, since there are 300 shares, the total dividend is 15 pesos per share. So we need to multiply this 15,000 pesos per share by 200 because that will be the number of shares being involved in this problem. So if we multiply 15 by 200, so that will be equal to 3,000 pesos. So that will be the total dividend no, in this problem. So in summary, the dividend is now equal to dividend percentage. So we multiply your dividend percentage by the par value, which is 500, and we multiply to the number of share, which is 200. So that in summary, that will be the formula no designed for the dividend. We just simply multiply your dividend percentage by your par value and to your number of shares, and that will be equal now to 0.03. If we convert this 3% to decimal, multiply by 500, and multiply by 200, and the final answer for the dividend now is 3,000 pesos. And for the final answer now, thus the dividend is 3,000 pesos. Meaning to say 3,000 pesos is the amount that Mrs. Lingan received as a dividend. So for example number 3, a corporation A with a current market value of 52 pesos give a dividend of 8 pesos per share of its common stock. Corporation B with a current market value of 95 pesos give a dividend of 12 pesos per share. So use the stock yield ratio to measure how much dividends stakeholders are getting in relation to the amount invested. So for the solution, we need to list down first, no, all the given values for corporation A. So the dividend per share is 8 pesos. The market value is 52 pesos. And we're asked now for the stock yield ratio. And what is the formula now for the stock yield ratio? So the formula now for the stock yield ratio is the dividend per share divided by the market value. So upon checking with the given values, so there is a value being given, no, for the dividend per share and for the market value. What we need to do now is to simply substitute the given values for the dividend per share and for the market value, and that will be 8 over 52. Upon simplifying, it becomes 0.1538, and if we multiply this one by 100, so we multiply this one by 100 to make it 15.38%, and that will be the stock yield ratio for Corporation A. Now, going to your Corporation B, the dividend per share now is 12 pesos. And the market value for Corporation B is 95 pesos. So again, still the same that we're asked for the value of your stock yield ratio. It's the same formula. It's dividend per share over your market value. We just simply substitute your 12 as your dividend per share and 95 as your market value for the company's B. Now, upon simplifying this one, your 12 over 95 is now equal to 0.1263. And if we multiply this one by 100, that will be equal now to 12.63%. As you can see, with the summary of our result, your Corporation A has a higher stock yield ratio than Corporation B. Thus, each peso will earn you more if you invest in Corporation A. That's why that's the only reason, wherein it is more, it will earn more, your money will earn more if you invest in Corporation A because your Corporation A has a higher stock yield ratio compared to your company B. So if all other things are equal, then it is wiser to invest in Corporation A. Yes, it is because Corporation A again has a higher stock yield ratio. So as example 3 shows, the stock yield ratio can be used to compare two or more investments. That's why we simply use the concept of your stock yield ratio, for us to decide which of the company or companies that offers you for an investment or that sell a stocks, So which of the companies are better to deal with, or which of the company are best, to deal with. Now let's recall some of the terms which are related to your bonds. So there's a typographical error here, so it should be bonds. So first term, so let's recall the definition of your bond. So your bond is an interest-bearing security which promises to pay. So there is a promises here to pay first stated amount of money on the maturity date. So there is a promise to pay stated amount of money on the maturity date. And second is the regular interest payments called the coupons. Now, we can say that bonds is a fixed income instrument wherein that represent a loan made by an investor to a borrower. So typically a corporate or governmental. So these are corporate or governmental. So these are the borrowers. So a bond could be thought, no, of as an IOU between the lender and the borrower that includes the details of the loan and its payment. So we can say that bonds now are used by companies, municipalities, states, and sovereign governments to finance projects and operations. So owners of bonds are debt holders or creditors of the issuer, I mean. So those are the things that we need to take note about your bond. No, the next that your coupon. So by definition here, a periodic interest payment that the bondholder receives during the time between your purchase date and the maturity date. So usually receive semi-annually. So your coupon payment on a bond is the interest payment that the bondholder receives, no, from the bond's issue date until it matures. That's why it's the time between your purchase date and the maturity date. So coupons are normally, no, are normally described in terms of the coupon rate. So we can describe normally your coupon by coupon rate. So which is calculated by adding the sum of the coupons paid per year and dividing it by the bond's face value. So you need to take note of that we can calculate, no, this coupon payment by simply adding the sum of the coupons paid per year and dividing it by the bond's face value. So that's how we compute for the coupon payment. Now let's go now with the coupon rate. So the rate per coupon payment period, so denoted R. So we simply use small letter R to represent this coupon rate. So in a simple word, know that your coupon rate is the rate of interest paid by bond issuers on the bond face value. So these are the rate of interest that is being paid by the bond issuers on the bond face value. Or we can say that this is a periodic rate of interest paid by bond issuers to its purchasers. So please do take note of that. And the bond coupon rate is calculated on the bond's face value or par value, not on the issue price or market value. So you need to take note of this. The coupon rate is calculated on the bond's face value or par value and not on the issue price or market value. Now, in the next term, your price of a bond. So there's a typographical error here. It should be bond, not bind. So when we say price of a bond, so the price of the bond at purchase time, so denoted by your uh, big letter P. So simply use your big letter P to represent your price of a bond. So this price of a bond, no, is the present discounted value of future cash stream generated by a bond. Again, please do take note of this, that your bond rate, or I mean the bond price, is the present discounted value of future cash stream generated by a bond. So it refers to the sum, no? It refers to the sum of the present values of all likely coupon payments. So there's an involvement of coupon payments here. So plus the present value of the par value at maturity. So there is a coupon payment, there's an involvement of your coupon payments and the par value at maturity. So to calculate the bond price, no, one has to simply discount the known future cash flows. So there's an involvement of the concept of your cash flows here, wherein we can compute the bond price by simply applying, no, or by simply discount the known future cash flows. Now moving forward with the FAR value or face value, so the amount payable on the maturity date, so denoted by your big letter F. So we simply use this big letter F to represent this FAR value or face value. Now, your FAR value, we can say that your FAR value is the face value of a bond. That's why we simply replace your FAR value by simply using the term face value. So the market price of a bond, no, may be above or below FAR. So there are times that the market price can be below or above the FAR value. So depending on the factors such as, so please do take note of this. So it depends on the factors such as the level of interest rates and the bond credit status. So FAR value for a bond is typically, for example, it can be $1,000 or $100,000 in some foreign country, no? So because these are the usual denominations in which they are issued. So there is a particular amount that we can associate, no, to the FAR value of this bond. But you need to take note of this, that the market price of a bond may be above or below FAR. So there are times that your market price can be above or below your FAR value. It will be dependent on the factors such as the level of interest rate and the bond credit status. Now, there are three situations being given here. No, if your price of a bond is equal to the face value, which is your F, the bond is purchased at FAR. So there's a condition here. First condition, if your P is less than F or your price of a bond is less than your face value or FAR value, the bond is purchased at a discount. And if your P or your price of a bond is greater than F or the par value or face value, the bond is purchased at premium. So those are the three terms that we can associate with the FAR value or face value of a bond. Now, dealing with the term of a bond by definition here, so your term of a bond is a fixed period of time in years at which the bond is redeemable. So you need to take note of that. At which the bond is redeemable as stated in the bond certificate. So it was being stated on the bond certificate. So the number of years from the time of purchase to maturity date. So it was being stated in the bond certificate at which the bond is redeemable. That will be the term of a bond. So we can say that this term of a bond is the amount, no, is the amount time between the bond's issuance and its maturity. So we can say again, no, that the term of a bond is in between, is the time between the bond's issuance, when the time your bonds issued, no, up to its maturity. So that will be the term of the bond. The majority of bonds issued today are term bonds, and this may be contrasted, no, with serial bonds. So there's a serial bonds here to be given to you, no, which is also indicated on the bond certificate. And this may be, or it can be, I mean, which are constructed so that a portion of the outstanding bond matures at regular intervals. until all the bonds has matured. That's why this term of a bond is between the bond's issuance and its maturity. Now, going to the pair price of a bond, your pair price of a bond now, we can say that this is the present value of all cash inflows to the bond holders. So that's how we define your fair price of a bond. So for example number 4, as the problem number 4, determine the amount of the semi-annual coupon for a bond with a face value of 300,000 pesos that pays 10% payable semi-annual for its coupon. Now, first thing to do is to list down all the given values for the face value that will be F is equal to 300,000 pesos, and for the coupon rate that will be 10%. Now, we're asked to find the amount of the semi-annual coupon. So for the solution, no, by simply looking at the solution now, your annual coupon amount will be equal now to 300,000 if we multiply your face value, which is 300,000 pesos, by the coupon rate. So how can we compute for the annual coupon amount? By simply multiplying your face value by the coupon rate, which is once we convert this 10% to decimal, if we divide this 10% to by 100, I mean, so that will be 0.10 multiplied by your 300,000, and the resulting value now is 30,000. Now, if that is the annual coupon amount, and we're asked to look for the semi-annual coupon amount, we just simply divide, no, by 2 or multiply it by 1/2, whatever the resulting value that we get in computing the annual coupon amount, because the semi-annual coupon amount will represent the half of that annual coupon amount. If we multiply 30,000 by 1/2, so that will be equal to 15,000 now. And that will be the amount of the semi-annual coupon. So thus the amount of semi-annual coupon here is 15,000 pesos, as you can see. So we need to take note. The coupon rate is used only for computing the coupon amount. So we only apply this coupon rate for us to compute your coupon amount. So usually paid semi-annually. So if the given is annually, no? So we just simply divide it by 2 or we multiply it, whatever the resulting value that we can get, no? In computing the annual coupon amount, and that is the amount of the semi-annual coupon. It is not the rate at which money grows. Instead, current market conditions are reflected by the market rate, and it will be used to compute the present value of future payments. So that will be your coupon rate. Now let's deal with example number 5. So find the value of a 20,000 pesos bond with interest of 14% compounded semi-annually, which is redeemable at 108%. In 5 years, that yields the purchaser 6% converted semi-annually. So for the solution, finding the purchase price of the bond requires us to determine first the coupon payment and the redemption value of the bond. So using the information given in the problem, substitute the values to the respective formulas. Thus we have, so first thing to do is to list down all the given values. So that will your FB is 20,000 pesos. Your RR or the rate is 1.08. We convert this 108 to decimal. If we divide 108 by 100, that will be 1.08. Then RB is 0.14. That is compounded semi-annually. Your T or your term is 5 years. So your RY is 0.06. And M is equal to 2. Your B now is 0.14 because that is compounded semi-annually. If we need to convert this one by 2, we need to convert this one to compounded annually. That's why we need to divide this 0.14 by 2, and 0.07 that is being converted to compounded annually. Now your n is 5 multiplied by 2. Why is that it is 5? Because your t here is 5. There are two sets of 6 months in a year. That's why we need to multiply your 5 by 2, and it becomes 10 as the total number of semi-annually in 5 years. Now your R is 0.06 divided by 2 because that is converted semi-annually again. That's why we need to divide by 2 for us to convert this one to compounded annually, and it becomes 0.03 as the value of your I. Now, with these given values and the resulting values that we get in simplification or in conversion, no, substitute these values to compute the following. The coupon payment. How can we compute for the coupon payment? We multiply your 20,000 pesos by 0.07. So we apply this value, as you can see, and this value to this one, and we multiply. So the resulting value now is 1,400 pesos for the coupon payment. Now for the redemption value, your redemption value will be multiplied to 1.08. FB, F sub B multiplied by R sub R, which is 1.08. That will be 20,000 multiplied by 1.08. So that will be equal to 21,600 pesos. That will be the redeemable. That's why the bond with interest now at 14% compounded semi-annually, which is redeemable at 108%. No, it was being mentioned in the problem that we simply use your 1.08 as a rate of interest that will be multiplied to your 20,000 as your F sub B value for us to get the value of your redemption value here. And your final answer for this one is 21,600 pesos. So for the purchase price, as you can see, there is a given formula for the purchase price. So we just simply substitute all the given values for the unknown variables in this formula. So your P will represent your purchase price, or that will be equal to RB now, multiplied by 1 plus I raised to negative N, plus your CP multiply to the fraction here, which is now equal to 1 minus 1 plus I raised to negative N over your I. As you can see here, there's a given value now for RB, your I, your N, your CP, and to our listed values, no, in our first step in solving this problem. That's why we just simply substitute all the given values on this formula. Your P now is equal to 21,600 multiplied by 1 plus 0.03 raised to negative 10 plus 1 4 multiplied by 1 plus 1 minus, 1 plus 0.03 raised to negative 10. Your negative 10 here will be the exponent for 1 plus 0.3. So whatever the resulting value, no, from your 1 plus 0.03, that will be the base of this negative 10 as your exponent, all over 0.03. Now, the purchase price, as we simplify, these given values, as we substitute these values to your given design formula or the given or the design formula for your purchase price, and that will be 28,014 pesos and 71 centavos. So this will be your answer for your purchase price. Now, therefore, the investor who pays 28,000 and 14.71 pesos is investing the money. So that will be our final answer for this problem. For your activity, you're now asked to solve the following problems. So your first problem, a financial institution declared a dividend of 75 million pesos for its common stock. Suppose there are 900,000 shares of common stock. How much is the dividend per share? So you're asked to solve for the dividend per share for problem number 1. For problem number 2, the ABC Corporation give out 38 pesos dividend per share for its common stock. The market value of the stock is 10,800 pesos. Determine the stock yield ratio. So for problem number 2, you're asked to solve for the stock yield ratio. And for number 3, a bank declared a dividend of 27 pesos per share for the common stock. If the common stock closes at 93 pesos, how large is the stock yield ratio on this investment? And you're going to write your answers and solutions in your Katleya notebook. Thanks for watching. So please like, comment, and share, and subscribe.